Good morning. Today is the 14th of January and time is now 8:47 a.m. GMT. My name's Aaron Hill and welcome to another edition of Technical Talk. So Wednesday had US inflation data hit the wires, showing consumer prices increased 7% before seasonal adjustment over the prior 12 months. This represents an eye-popping four-decade high. The year-on-year core reading also came in at 5.5%. This is all items, less food and energy. The month-on-month figure, of course, came in at 0.5% versus economists' forecasts of around 0.4%. The monthly core figure was 0.6%, a marginal beat on expectations of 0.5%. Now, the 7% December CPI print did not prevent the dollar from weakening broadly, which, as you can see from the chart, overthrew trendline support on the daily time frame, and this is drawn from the low 89.84 on the US dollar index, which is simply the geometric weighted average of 6 international currencies weighted against the greenback. Now, the euro carries the lion's share with an index weighting of 57.6%. Anyway, you can see the US dollar has continued to explore lower terrain and is now shaking hands with daily support around 94.65. In terms of yesterday's economic data, namely initial jobless claims and producer prices out of the US, were really not much to write home about, as they were really not far from consensus estimates. US initial jobless claims came in a touch higher at 230,000, 23,000 higher than the prior week's value of 207,000. PPI for December increased 2% in 0.2% in December, seasonally adjusted. The rise, of course, followed advances of 1% in November and 0.6% in October. Going forward today, US retail sales is on the radar at 1:45 p.m. GMT, with both headline and core readings anticipating a modest drop. US industrial production follows at 2:15 p.m. GMT, with anticipations of a mild decline from November's print. Okay, on to the markets. Asia equities ended in the red overnight. Japan's Nikkei 225 was down 1.3%. South Korea's Kospi was also down 1.4%, with the Australia's ASX 200 down 1.1%. Early European equity indexes are lower across the board, with London's FTSE 100 down 0.1%. Germany's DAX down 0.7%, and France's CAC 40 down 0.7%, with Euro Stoxx 50 down 0.9%. And we're also seeing a reasonably positive tone in US equity index futures right now. So on to the charts, the euro dollar. Long term, we are now at a resistance area. This is the weekly time frame. We are at a resistance area at 1473, 1583. This follows a period where buyers and sellers were squaring off between support at 1.1237 and 1.1281. Now, this is a Fibonacci resistance. As you can see, it also represents an alternate AB equals CD bullish pattern. So we are at a resistance area on the weekly time frame. However, on the daily time frame, we did break a 7-month-long trendline resistance, which is generally considered a bullish signal. Though with weekly resistance in play, the break of the daily trendline resistance may be short-lived. Also of technical interest, of course, is the H4 time frames Fibonacci resistance. Now, this comes in between 1.1506 and 1.1476, and this is fastened to the underside of the weekly resistance area at this point here. H1, as you can see, exhibits scope to approach 115. This is the H1 chart after retesting a quasi-motor resistance turn support at 1452. So in light of weekly, this is the weekly time frame, in light of weekly and H4 Fibonacci resistance, we're likely to override H1 support and any break of a trend line resistance. So I am looking at a possible move lower from this H4 resistance area to target H4 support around the 1438 region, followed by a possible move into the 114 region on the H1 timeframe. Moving over to the Aussie dollar really quickly, we are still coming out of prime support on the weekly time frame at 68.72.42. Now, on the daily time frame, we did have a near test of daily resistance between 74.25. It's now 74.23 because the upper edge is reinforced by the 200-day simple moving average. So that's between 74.23 and 73.15. As you can see, we come within a pip of that area yesterday and formed what many candlestick enthusiasts will recognize as a shooting star candle. Alongside this, we also had H4 price. This is the H4 time frame. Touch gloves with prime resistance at 73.23, 73.08, as well as a H4 stop run above the 73 figure on the H1 time frame. As you can see, we popped above the round number, took out a truckload of buy stops and connected with the H4 prime resistance, and have since declined lower and cross swords with H1 support at 72.73. Now, with this being said, if we do close below this H1 support, I am potentially looking at lower prices on the Aussie dollar down to possibly testing the H4, as you can see, H4 quasi-motor resistance at 72.50. I think that's 72.52. No, that's 72.50, followed by a possible run to the H4 demand at 72.05, 72.17. Now, over onto the dollar yen. For those who follow our regular analysis, will note we highlighted the 1.272% Fibonacci projection on the weekly time frame at 116.09. As you can see, we did form a shooting star candle pattern off of this region and are currently down 1.5% on the week, which has subsequently led to a price taking out support at 114.38. Now, continuation lower on the weekly time frame has support at 112.16 to target. As you can see, this support has a reasonably good history as a resistance, so a reaction from this support is possible. On the daily time frame, we have room to continue lower according to the chart studies to as far south as demand at 112.66, 112.07, followed by a decision point at 111.18, 111.79, and the 200-day simple moving average at 111.32. Now, do note that in between these two areas is obviously the weekly support at 112.16. Now, on to the, so with weekly and daily timeframes leaning towards lower prices, this could pull H4 and H1 prices below their respective decision points. So we have a decision point on the H4 time frame at 113.54, 113.78, and also on the H1 time frame at 113.67, 113.76. But as I said, given that we are looking at lower prices on the higher timeframes, any upside attempt from this area may be short-lived. However, in saying that, we are seeing potential bullish divergence emerge from the RSI, which could lead to a pop higher to at least the 114 handle on the H1 time frame, which coincides with a small decision point, which I haven't marked up yet, a small decision point around the 114.05 area. This is the lower edge. Okay, finally on to the pound. So focus right now on the pound dollar is the daily time frame connecting with the 200-day simple moving average at 137.33. Now, do note we did form a bearish shooting star candlestick formation, which has failed to generate any bearish showing. But nevertheless, we are still connecting with the 200-day simple moving average and will be watched closely by market participants. A price cross above this moving average will likely see a test of highs around the 38.30-ish region. And a price cross is likely to be seen as a sign we are obviously headed for higher levels. Beyond the tops here, we are looking at a possible move to the quasi-model resistance at around 38.87-ish. So that's a wrap from my side this morning. As usual, any questions or comments, please email the research team at marketsanalyst@fpmarkets.com. With that, thanks for joining, trade safe, and have a wonderful weekend.